Banks are currently facing a significant issue of unrealized losses, where the market value of assets is less than their purchase price. US banks are currently holding billions of dollars in incurred losses, particularly on the United States treasuries and mortgage-backed securities. As of the end of the third quarter, the total amount is reported to be $684 billion. If these were realized simultaneously, it would lead to the collapse of the banking system. They have been managing this damage through short-term bailout programs like the Bank Term Funding Program. The unrealized losses on balance sheets are causing challenges as they are constraining their ability to lend. These losses will become a significant problem over the next few years. The entire sector is facing serious liquidity concerns as they are finding it difficult to maintain liquidity. They are borrowing from the Federal Home Loan banks at high rates to address these concerns. Additionally, some of them are incurring expenses and need relief. Liquidity issue is a significant factor behind this crisis. Addressing these challenges is crucial to prevent negative outcomes for the broader economy. When securities are purchased, they are not necessarily required to be marked to market regularly. Instead, they are carried at their purchase price on the books. This means that the market value of these securities is not consistently recorded and updated. This lack of frequent revaluation leads to the existence of these losses, which are the differences between the current market value of the securities and the price at which they originally purchased. They invested in bonds when rates were low, and the hikes led to a decline in the value of both held to maturity and available for sale securities. Bank of America had unrealized losses of $131 billion on securities in the third quarter. Despite the staggering amount, it expresses confidence that the portfolio's incurred losses will not translate into actual losses in the long term. It attributes this damage to government-guaranteed securities, particularly bonds categorized as held to maturity. It anticipates zero losses over time. They have belief that they will receive the full bond principal at maturity and expect that investors will get all their money back. Silicon Valley serves as an example of the impact of incurred losses and the associated difficulties, as it sold a portfolio of its holdings at a sharp loss during the summer, which led to their collapse. It had caused turmoil in industry, but this event has brought increased scrutiny from investors on unrealized losses. Higher annual percentage rates on bond prices make outstanding bonds less valuable. These events are so severe that even businesses who plan to hold bond investments to maturity are forced to sell it, which ultimately translates to selling of assets. The high-yield corporate bonds and leveraged loans suggest that the distress will lead to an increase in unemployment. The distress in corporations is a threat to employment of 19 million employees at the brink of losing their jobs. The bond market's internal pricing suggests a forecast of rate cuts by the Fed. The Federal Reserve's role in managing inflation and interest rates is intertwined with concerns about the national debt and fiscal deficits. Rising bond yields, coupled with concerns about its deficit mismanagement, pose harms to the economy. GM Morgan Chase is grappling with a substantial $40 billion in unrealized losses, indicating a significant 20% surge from the previous quarter. This revelation has sent shockwaves throughout the sector, which is impacting major players like Bank of America, Wells Fargo, and Citigroup. This news underscores the fragile nature of the market and raises concerns about ripple effects worldwide. The unexpected losses at JP Morgan highlight the vulnerability of even the most esteemed financial institutions. The significant changes are occurring in the financial landscape, and losses are amounting to $40 billion. These losses become significant challenges when they need to borrow money from other institutions. The unrealized losses faced by JP Morgan Chase are due to the decline in the value of their bond portfolios. As interest increases, the value of existing bonds tends to decrease. This situation is part of a significant shift in the financial landscape as the Federal Reserve struggles to control rising rates. The unrealized losses on bonds contribute to the overall challenges faced by the industry and ultimately heading towards a broader financial crisis. Aggressive interest rate hikes by the Federal Reserve is the significant factor, which led to a situation where the value of both types of securities, held to maturity securities and available for sale securities, declined. The increase in interest resulted in the billions of dollars worth of unrealized losses. These losses represent the difference between the market value of the securities and the purchase price recorded on the books. The longer the Fed keeps interest rates high, the longer banks will have to use the Federal Reserve bailout program, known as the Bank Term Funding Program. This program allows them to borrow against their devalued assets and provide them a short-term solution. This program doesn't solve the underlying issues and problems, but merely buys time. If the Fed decides to increase rates again, then these unrealized losses will likely continue to grow. These will create further challenges for them, especially if they need to access additional liquidity in the future. Federal Deposit Insurance Corporation data reveals a decline in net income for the sector, which is driven by lower non-interest income and higher realized losses on securities. According to the Federal Deposit Insurance Corporation quarter report, incurred losses on U.S. treasuries and mortgage-backed securities held by U.S. banks increased by 22%, or $126 billion, as of the end of the third quarter. The data shows that the total amount of unrealized losses as of September 30th is reported to be $684 billion. Federal Deposit Insurance Corporation took over First Republic and Signature Bank as they had substantial unrealized losses. These takeovers indicate the seriousness of the situation. This sector is citing alarming signals, such as the CEO of JP Morgan Chase selling millions of dollars in his own company. Aggressive interest rate hikes by the Federal Reserve is the significant factor, which led to a situation where the value of both types of securities, held to maturity securities and available for sale securities, declined. The increase in interest resulted in the billions of dollars worth of unrealized losses. These losses represent the difference between the market value of the securities and the purchase price recorded on the books. The longer the Fed keeps interest rates high, the longer banks will have to use the Federal Reserve bailout program, known as the Bank Term Funding Program. This program allows them to borrow against their devalued assets and provide them a short-term solution. This program doesn't solve the underlying issues and problems, but merely buys time. If the Fed decides to increase rates again, then these unrealized losses will likely continue to grow. These will create further challenges for them, especially if they need to access additional liquidity in the future. Federal Deposit Insurance Corporation data reveals a decline in net income for the sector, which is driven by lower non-interest income and higher realized losses on securities. According to the Federal Deposit Insurance Corporation quarter report, incurred losses on U.S. treasuries and mortgage-backed securities held by U.S. banks increased by 22%, or $126 billion, as of the end of the third quarter. The data shows that the total amount of unrealized losses as of September 30th is reported to be $684 billion. Federal Deposit Insurance Corporation took over First Republic and Signature Bank as they had substantial unrealized losses. These takeovers indicate the seriousness of the situation. This sector is citing alarming signals, such as the CEO of JP Morgan Chase selling millions of dollars in his own company. Community banks, especially small to mid-size ones, are facing difficulties in managing interest rates, real estate portfolios, and economic conditions. They are reported to have lower net income for the quarter and can be forced to sell undervalued securities to gain liquidity, especially if there's a significant credit event or downturn. They are borrowing from the federal home loans at high rates to address liquidity challenges, which is borrowing relief. This has an impact on both larger and smaller institutions, which indicates a complex interplay between banks, unrealized losses, and FHLBs in the current financial landscape. Moody's issues a negative outlook for the entire global sector for 2024 due to a deteriorating operating environment, which is surging delinquencies. It hints about the risks in crude oil markets and overall market sentiment, which is linked to central banks' tighter monetary policies to lower GDP growth. The commercial and individual loan defaults are increased due to low liquidity. Moody's expects GDP growth among advanced economies to decelerate with tight monetary conditions, which is expected to continue in 2024. The mixed performances have shown that revenue is primarily driven by higher interest rates, which are deemed unsustainable in the long run. The concerns about Africa and the Middle East facing bad loans increases. Developed countries, including the United Kingdom and Canada, are going to experience declining consumer confidence, and rising unemployment will lead to bad loans. The United States, specifically in commercial real estate and private credit funds, is an area of concern. Unemployment will be rising in most G20 advanced economies in 2024, except for Japan and Germany. The overexposure to real estate is a vulnerability for American and European banks who are facing liquidity concerns that will weaken asset quality. These factors will contribute to growing loan defaults and financial instability if conditions worsen. The United States national debt is stated to be $33.7 trillion and counting. The interest payments on this debt are expected to be higher, the Federal Reserve increasing interest rates and using quantitative tightening adds to economic uncertainties. The government borrowing a lot of money is causing a cycle of increasing debt, and by 2033, the interest payments alone will be $1.4 trillion. The US Treasury is issuing millions of dollars worth of new debt to finance its growing deficit. The focus of the government is on spending rather than investing back into public programs or infrastructure. Many people perceive that the national deficit is not directly affecting them or believe that the US will never have to pay it back. There are two types of debt. One is public debt, which is held by individuals, foreign governments and corporations, and the other is intergovernmental debt, in which the government owes money to itself through agencies like Social Security. The United States Treasury manages both public and intergovernmental debt. Money for borrowing comes from sources like the Social Security Trust Fund, which has more revenue than needed. Almost 80% of the US national deficit is owned by the American public, including Social Security, retirement and pension funds. US Treasury securities are sold to investors, including individuals, foreign governments and corporations. Investors can purchase them directly from the Treasury or on the secondary market. The Federal Reserve is a holder of approximately 35% of the publicly held debt, and it can buy Treasury securities on the secondary market. Social Security is a significant holder of intergovernmental debt, which lends extra funds to other agencies and is a major contributor to the available money for borrowing. Investors in the US national debt can be categorized into three main groups, which are individuals, foreign governments and corporations. Foreign governments, including Japan, China and the United Kingdom, hold a significant portion of the US public debt, with China actively selling off its US treasuries. There is a historical trend of foreign governments like China and Saudi Arabia moving away from holding massive amounts of US deficit and preferring alternative assets like gold. Foreign investors express concerns about the increasing US deficit, geopolitical factors, and are interested in alternative investments. The dependency of the United States on foreign lenders has been increasing over the decades, with foreign holdings growing from 5% in the 1970s to 30% in 2022. Financial giants must reassess risk management practices in the face of unprecedented, unrealized losses. Resilience and vigilance is needed to withstand the tempest of a volatile financial climate. Stakeholders are urged to craft a resilient framework to shield against the domino effect of unrestrained financial tremors. We need careful wealth management to prevent a downturn. A shortage of cash, demands for more money, and quickly selling off assets can seriously affect the economy and people's financial situations. It's important for individuals to be aware of these signs and adjust their financial plans for economic difficulties. Comment down below on what you think. And if you liked this video, please consider liking, subscribing, and sharing the video. Thanks for watching, and we'll see you in the next one.